Why did a diplomatic standoff over an ocean strait halfway across the world suddenly force Wall Street to dump your Bitcoin?
Yeah.
If you're looking at your portfolio today, you're probably trying to make sense of this whole mess.
Yeah, I mean, it is a brutal tug of war right now. You've got intense macroeconomic anxiety just slamming straight into a network that is honestly rapidly maturing.
Exactly. So we are taking a deep dive into this aggressive market recalibration for you today. We want to figure out what's actually driving the squeeze.
Right, and to understand that, we have to look at the data. Bitcoin hit a really severe liquidity trap exactly at $78,269.
And then just mechanically cascaded down.
Right, straight down to $76,134, which, completely wiped out all those speculative longs in the process.
While that was happening, U.S. spot ETFs just bled out. I mean, we saw over $263 million exit the market, which completely snapped that 9-day inflow streak we were tracking.
Yeah, Fidelity really led that exit, though I think it is notable that BlackRock held flat, zero net outflows for them.
Which is interesting, but overall, it feels like an institutional flinch. Like Wall Street just pulling its hand back from a hot stove just days before this crucial FOMC meeting.
That's a good way to look at it, because the macro catalyst here, the real why behind the fear, isn't even crypto native, it's oil.
Oh, right. Brent crude breaching, what, $108 a barrel?
Yeah, $108. And that's because of a severe geopolitical deadlock. The U.S. formally rejected a proposal from Iran to reopen the Strait of Hormuz.
Because the deal totally excluded any nuclear concessions, right?
Exactly. Completely excluded them. And with Russia now publicly backing Iran, the market is suddenly realizing this maritime paralysis is locked in. It guarantees sustained high energy costs.
Okay, wait, let's connect the dots here for the listener. So a locked strait halfway across the world is mathematically forcing Wall Street algorithms to dump your Bitcoin. How does that actually work?
Well, high oil prices feed directly into forward-looking inflation metrics. And when inflation threatens to run hot, the Federal Reserve is essentially forced to keep interest rates high.
Ah, I see.
Yeah, so those Wall Street algorithms just instantly react. They pull capital away from non-yielding assets, like digital assets, and retreat to cash or bonds. It is just automated capital flight.
So the algorithms are punishing the asset price based on inflation fears. But, if we look past the ticker for a second, the base layer itself is hardening in ways we just haven't seen before.
Well, absolutely. The corporate maturation is undeniable right now. Look at Blocking.
Right. They just verified their $2.2 billion Bitcoin treasury.
Using third-party on-chain signatures, that completely obsoletes legacy accounting. You don't need to trust an accounting firm to manually verify bank statements anymore. You just check the cryptography.
It's wild. And the jurisdictional foundation is hardening right alongside it. The FBI director and the acting attorney general just categorized cryptographic code as protected free speech.
Which is a massive paradigm shift. But, we really have to contrast that rock-solid base layer with the utter chaos happening on secondary layers right now.
You mean the DeFi fragility?
Yeah, exactly. Zetachain just had to halt its entire mainnet over a really basic contract exploit.
And then you have that DeFi United coalition frantically using staged Ethereum deposits just to patch a $292 million deficit.
All because of North Korean state hackers. When you rely on complex smart contracts to bridge assets, you create these massive honeypots. One flaw in the code, and the whole thing just drains.
Okay, let's unpack this reality for a second. If corporate giants are actively weaponizing Bitcoin's transparency to replace legacy banking, why are institutional investors still treating it like a standard disposable risk-on asset?
Because traditional finance still evaluates everything through the lens of fiat liquidity. Until this macro storm passes, those algorithms are going to keep trading the asset based on short-term inflation fears. They just ignore the underlying network maturation.
So we are witnessing a totally fragmented reality. Macro algorithms are punishing short-term leverage, while corporate treasuries and sovereign agencies are quietly cementing the base layer's long-term utility.
That's exactly what's happening. The two sides aren't even playing the same game.
It really is fascinating, and I want to leave you, the listener, with a final thought to mull over today. If cryptographic code is now officially recognized by federal law enforcement as constitutionally protected free speech, could future attempts to restrict the network trigger a fundamental constitutional crisis rather than just a financial one?